He hunted frauds for 20 years. A jury just convicted him. $21 million. The man who built his reputation on calling out corporate liars sat in a Los Angeles federal courtroom in early June 2026 and listened as a jury found him guilty on 13 counts. 1 count of a securities fraud scheme. 12 counts of securities fraud. The conduct, according to the Department of Justice, ran from March 2018 to October 2023. 5.5 years. The profit prosecutors proved at trial was at least $21 million. His name is Andrew Left. For 2 decades, he was the most feared activist short seller in the United States, the founder of Citron Research, a fixture on CNBC, Fox Business, and Bloomberg Television. A man whose published reports could shave billions off a market capitalization before the closing bell. 300,000 followers waited on his next post. Hedge fund traders kept his number. Cable news producers held a chair for him. In early June, a federal grand jury's work concluded in conviction. The man who had spent 20 years explaining how other people manipulated markets had, prosecutors proved to the jury, been manipulating one himself. The question the script will circle but cannot answer is the one the trial itself opened. What happens to a man whose legitimate weapon stops working? Andrew Left started in 2001 with a website called stocklemon.com. By 2007, he had rebranded it as Citron Research, and the model was set. It was for a long time legal, and on its face, public-spirited. Find a publicly traded company you believed was overvalued or dishonest. Take a position betting its stock would fall, a short position, a wager on decline. Publish a report explaining why. Let the market do the rest. Short selling is the inverse trade. A normal investor buys low and sells high. A short seller bets the other way. He profits when a stock falls, which means when the target is genuinely dishonest, he has a built-in incentive to dig up the fraud. Finding it pays. For most of his career, Andrew Left did the work. In 2012, Citron flagged China Evergrande, the property developer that would eventually become the most consequential corporate collapse in modern Chinese real estate. A call so early, it got Left banned from trading in Hong Kong at the time. In 2015 came the report that built the brand. Citron published on Valiant Pharmaceuticals, and Left called it, in writing, the pharmaceutical Enron. Citron alleged channel stuffing, pushing product into the distribution chain to inflate apparent sales, and fictitious transactions through a network of affiliated pharmacies. The stock collapsed. Valiant later paid a $45 million regulatory fine without admitting or denying wrongdoing, a separate outcome on the company's own conduct, not a confirmation of Left's claim. But the timing was enough. Citron became the name that targets feared and reporters quoted. By the late 2010s, the routine was set. A Citron tweet could erase billions in market value before lunch. Hedge funds called for tips. Cable producers booked him on the day of a report. He spoke at industry summits. He lived in Beverly Hills. The system that made him had no rules for what he did inside it, and then the weapon stopped working. In January 2021, Andrew Left shorted GameStop. The stock was trading in the single digits. The company was widely seen as a fading mall anchor brand, and the short trade looked, by the conventions of the industry, routine. It was not routine. A coordinated wave of retail traders on Reddit and X drove the price upward at a speed the short side had not budgeted for. Citron's position, according to public reporting, lost roughly $20 million in days. Left went on video and announced he would stop publishing short reports. Citron, he said, would no longer call individual stocks down. The era of the short seller, as villain of the small investor, had changed him. What he did not say, and what the jury would later find, was that the conduct prosecutors charged him with had begun 3 years earlier and would continue for almost 3 more. Around the same time as the GameStop loss, the FBI searched his Beverly Hills home. The Wall Street Journal reported the search. The federal investigation had been quietly underway since 2018, examining the long-standing, lightly regulated relationships between activist short sellers and the hedge funds that traded alongside their reports, the back channels, the timing, the question of who knew what was coming before the public did. Then came the small, specific signals. The Wall Street Journal documented one Roku trade in which, according to its reporting, Left exited a position for a profit of roughly $700,000 within hours of publicly calling the stock uninvestable. He later deleted the post. One trade, one deleted tweet in a feed that drove markets, a detail that on its own meant little and in retrospect meant a great deal. In October 2024, a former Citron associate named Ryan Choi settled civil charges with the Securities and Exchange Commission, agreeing to pay more than $1.8 million over conduct the SEC framed as negligent, tied to two specific tweets. A settlement is not an admission of guilt, and Choi did not admit any. But it was the first piece of the Citron operation to enter the public record of regulatory consequence. The associate had paid. The principal had not yet been tried. In July 2025, a federal judge rejected Left's motion to dismiss the case. The trial would go forward, beginning in March 2026. The full mechanism arrived at trial. According to the indictment and the evidence prosecutors put before the jury over 15 days, the scheme worked like this. Citron would publish a report, or Left would post on X to his 300,000 followers, naming a stock he said was a sell and in many cases a specific target price he expected it to fall to. The followers would react. Some would sell their existing positions. Others, more aggressive, would open shorts of their own. The price would move in the direction Left had publicly predicted. And Andrew Left, prosecutors proved, would be on the other side of the trade, buying back the shorts he had himself opened earlier, taking the profit, while his followers were still selling on his call. When he posted a target he was bullish on, the inverse ran. The public post was the bait. The private trade was the switch. The Securities and Exchange Commission, in a parallel civil case filed the same day as the criminal indictment in July 2024, used exactly that phrase, bait and switch. The SEC counted 23 companies, 26 occasions, and a scheme worth roughly $20 million in its separate civil framing, a distinct legal scope from the criminal $21 million. Not the same case, not additive. Two different agencies, two different statutes, one course of conduct. The DOJ also alleged something else, and this is where the picture stops being one man at a keyboard. Prosecutors alleged that Left coordinated with hedge funds, sharing the timing of his announcements in advance, allowing them to trade ahead of his publication in exchange for a cut of their profits. The funds were not named in the indictment as defendants and have not been publicly charged. What the indictment described was a private market for advance notice of a public report, and it was inside exactly that channel that prosecutors found the line. In August 2018, in a message to a contact at the hedge fund Anson Advisors, a message the FBI later pulled from Left's phone and presented to the jury. Left was discussing which stocks were best to short. Small, retail-held names, he said, were the easiest. He pointed to the Toronto-listed cannabis company Kronos Group, and he described what it was like to move a stock owned by the retail investors who followed his commentary and then trade against them. It was, he wrote, like taking candy from a baby. 300,000 people were the baby. Not anonymous market actors, the people who watched him on CNBC and treated a Citron call as the due diligence they couldn't afford to do themselves. They got no notice that the man whose call they were trading on was, in the same minutes, on the other side of their trade. Now, the easy frame for this story is hypocrisy. The fraud hunter was a fraud. But the jury did not convict Andrew Left of hypocrisy. The jury convicted him of specific acts on specific dates against specific people. And the dates matter. The conduct period in the criminal case ran from March 2018 to October 2023. Look at where the GameStop loss falls on that line. January 2021, almost exactly in the middle. The manipulation, prosecutors proved, did not start when the legitimate weapon stopped working. It was already 3 years old by the time GameStop happened, and it did not end when he announced he was stepping back from short reports. It continued for almost 3 more years after that announcement into the autumn of 2023. The implication the jury accepted is not that a respected short seller broke under the pressure of one bad trade. It is that the two operations, the public research that built the reputation and the private trading the indictment described, had been running in parallel for the entire second half of his career. The reputation was real. The conduct the jury found was also real. They were not phases. They were simultaneous. After the verdict, Andrew Left was released pending sentencing, scheduled for August 31st, 2026. He faces statutory maximums of up to 25 years on the scheme count and up to 20 years on each fraud count. Those are the ceilings Congress wrote into the statute, not predictions of what a judge will impose. He is expected to appeal, and the verdict itself is not yet final. Immediately after the jury was dismissed, Left's lawyer asked the judge to throw out the result, a mistrial. Over a clerical error, the jury had been handed an outdated verdict form, one that still listed a charge the court had already dismissed before the trial. The judge said she would rule on the request later. As of now, she has not. So the conviction stands, but a motion to undo it is still on the table, and an appeal is expected on top of that. His defense throughout was that he was a publisher. His attorney, James Spertus, framed Citron as a research operation that had taken extraordinary steps to comply with securities law and characterized the prosecution as an attempt to regulate a new category of market commentator, the financial influencer, the public-facing researcher whose opinions move prices. Left himself chose to testify in his own defense across the 15-day trial. After the verdict, he called it a sad day for free speech and argued it was inconceivable he could have moved the stocks of massive companies on his own. The jury heard him. The jury convicted on 13 counts and acquitted on 4. The 300,000 followers received no restitution from the verdict itself. A criminal conviction is a finding about a defendant. It is not, by itself, a check in the mail to the people on the other side of his trades. And around Andrew Left, the model he embodied was already disappearing. Hindenburg Research, the firm that broke open the Nikola electric truck case, disbanded itself in early 2025, voluntarily, while still operating. Jim Chanos, who had shorted Enron before it fell, closed his hedge funds in 2023. The activist short seller, the lone researcher who profited by exposing what regulators had missed, was a species in retreat before the verdict ever landed. Andrew Left's conviction did not end that era. The era was already ending. His conviction marked it. The story sold to the public was that short sellers were the cleanup crew of the market, the unpaid inspectors who did the work the SEC could not afford. Some of them were. Some of them, prosecutors proved in this case, were running the same playbook as the companies they hunted, only better packaged. The system that produced Andrew Left, the cable bookings, the unregulated influence over a follower base measured in the hundreds of thousands, the absence of any rule requiring a researcher to disclose what he was personally trading at the moment he was publishing, did not catch him for 20 years. A federal grand jury did. Eventually, the jury found on 13 counts that the man the market trusted to expose manipulation had been running it. The appeal and the pending motion will determine what survives of that verdict. The model he built will not. So here's the question for the comments. Was Andrew Left a market watchdog the SEC could not afford, finally caught for the way he funded the work? Or was he, from the beginning, the same kind of operator as the companies he hunted, only louder? Pick one. Every empire falls eventually. Follow Exposed Empire for the next one.